Hey friends, stock market is in deep correction mode now. Nifty index has corrected around 1200 points from its peak, and this correction is even deeper in mid-cap and small-cap sector. However, the biggest shocker is the price correction of newly listed tech companies. Last year, we saw big names being listed on Indian stock market. For example, we saw the listing of Zomato, Paytm, Nykaa, Policybazar, and many more such new-age technology companies. And the Indian stock market went gaga about these new-age technology companies. In fact, Zomato was listed at a premium of 66% from the IPO price of Rs 76 to listing price of Rs 126. And that has now corrected around 45% from its peak to current levels of Rs 92. Although Zomato is still about 21% from its IPO price. Then Paytm was already listed at a loss of 27% from the IPO price of Rs 2150 to listing price of Rs 1564. However, the share price has fallen 53% to current levels of Rs 917. Nykaa was listed at a premium of 96% from IPO price of Rs 1125 to listing price of 2206 and has now corrected around 32% from its peak to current levels of 1742. Policybazar was listed at a premium of 22% from the IPO price of 980 to listing price of 1202 and has now corrected around 47% from its peak to current levels of 1470. Now the question is, why these newest tech companies are falling drastically? Let me tell you the reason. So before these tech companies launched their IPO, the traditional valuation of a company would be based on price to earning ratio, that is PE ratio. So basically, investors would value a company based on the earnings it would generate. For example, if the earning per share of the company is Rs 50 and its share price is Rs 1200, then its PE ratio would be 24. And investors would look at its historical PE ratio or PE ratio of similar companies in the sector to identify whether the current PE ratio is justified or not. Based on that, investors would say that the stock is overvalued, undervalued, or fairly valued. Again, PE ratio is not the only valuation criteria, but it is a widely accepted technique to check the valuation of a company. Now what happened is, launched of these newest tech companies. It was started with Zomato that launched its IPO in the month of July 2021. Now during that time, the stock market in India was in a bull run and there was euphoria in the market. Obviously, every company would try to time their IPO during a bull run. And there were a lot of young investors entering into the Indian stock market post-COVID crash. Everyone was looking at multi-bagger returns in no time. And these newest tech companies looked like a lottery ticket for multi-bagger returns. One of the reasons was bright future growth prospect. For example, online food delivery market in India is growing rapidly. And Zomato is one of the leaders in this segment. Then Nykaa is again uniquely positioned due to its high market share in Indian e-commerce category, especially in the fashion and beauty segment. So this created a state of FOMO in the market, that is fear of missing out. During the euphoria, every investor wanted a pie in these newest technology companies, but they missed one important aspect, valuation. Unfortunately, these new age companies were not profitable. Hence, the traditional PE ratio metric was not applicable on them. Although, people started looking at a new metric called price to sales to justify their valuation. And there was a rush to buy these technology companies at any valuation. In fact, just look at the level of craziness. Zomato launched its IPO at a valuation of Rs 50,000 crore and within a few months, investor took its valuation to over Rs 1 lakh crore. Now, how do you justify valuing a company at over Rs 1 lakh crore within a few months when the company is valuing itself at Rs 50,000 crore? At its peak, Zomato touched a market cap of Rs 1.33 lakh crore and from there it has corrected to current market cap of 71,000 crore, therefore eroding a market cap of around 61,000 crore. And this is something that is not new in the world of stock market. When there's a bull run, people buy companies at any valuation. And when there is a bear market, these companies correct. Especially during the bear market, the newest tech companies would fall even more as they command high premium due to their high growth prospect. Now this fall is not only in the Indian market. In fact, if you look at the US market, many of the companies have corrected heavily. In fact, Nasdaq has corrected around 15% and has erased all the gains in the last 1 year. And the reason is simple. US Fed has already announced the interest rate hikes to curb inflation. So there is a correction in the overall market. But yes, since these technology companies were commanding a high premium, they have corrected heavily. And that is the reason I always suggest looking at valuation. Don't just buy any company at any levels unless you are investing in a SIP mode. So if you are investing systematically at different levels with a goal of long-term investment, then you don't need to worry. Although there are a few learnings from this market correction. First learning is to diversify your portfolio. Do not just invest in technology sector or banking sector, as sectoral investing is very risky. Make sure that you diversify across sectors as well as diversify by investing across large, mid and small cap. So when the market is going up, it is very tempting to buy small cap stocks or high growth stocks. But it is equally important to have quality blue chip stocks in your portfolio to diversify your risk versus reward. Second learning is to ensure that you have invested in fundamentally strong companies. Never invest without looking at fundamentals, because when there's a bull market, everything looks rosy, but the real picture comes during the bear market. And the best part of investing in fundamentally strong companies is that every fall in fundamentally strong company create a buy opportunity. So this lesson is not only applicable for tech companies, but for every stock in general. Then third learning is avoid FOMO. Do not invest at any level. Valuations are very important. So make sure that you invest in fundamentally strong companies at right valuation. And final learning is to remind yourself what is your financial goal and why have you invested money in stock market. If you have invested money in stock market with a long-term investment horizon, then you don't have to panic. Indian economy has a bright growth prospect in the next 10-20 years and you should not panic with these corrections. As far as these technology companies are concerned, sure, there will be some companies that will become multi-baggers, but not every company would become a multi-bagger. So you need to study the business of the company, its future growth prospect, and then decide if you want to invest or not. I do not want to give any buy or sell call, because at the end of the day, you need to decide what is right or wrong. Personally, I have not invested in any of these new age technology companies, as I have always found them expensive. Although if this correction would continue, I might consider adding some of them for long-term wealth creation. I hope you will find this video useful. I'll see you in the next video. Till then, take care.